How would you characterize last year's investment environment?
Last year's stock markets were definitely macro-driven, and we ourselves spent a great deal of time handicapping what was going to happen in the US-China trade war, Brexit, Hong Kong protests, and so on. Global stock markets climbed the proverbial wall of worry and ran away from many investors. The result was a very unexpected increase in stock markets, with many hitting all-time highs. Using the S&P 500 as a proxy, for example, the market hit all-time highs, but it was all due to PE expansion with little help from earnings. We see this clearly in the following PE ratio chart, showing the multiple expanding from 14.5 to almost 18.5, or 24%. To make things even more difficult for investors, the market melt-up was led by a relatively low number of stocks, which meant that fewer number of investors participated. We see this dispersion very dramatically on this chart, which shows that the stocks investors believe are more stable and defensive, i.e. least risky, now make up over 70% of the S&P 500, the highest ever going back to 1925. Going forward, we believe the most dramatic impact will be felt by active managers.
How will active stock picking add value?
We believe the risk-reward favors active management versus passive. Let me explain. If we look at the same chart again, but now focus on the green line, we see that the stocks whose earnings are more tied to economic growth, like financials and industrials, also known as cyclicals, now make up less than 30% of the S&P 500, a record low. What does this tell us? It says that there is a historical wide dispersion between stocks that attracted all the capital and could do no wrong, versus stocks where the market perceives the risk of owning them as being way too high. We think the opposite. We believe that because of depressed valuation and low investor sentiment, the risk reward is very compelling. This brings us to the question of active versus passive. As a passive investor, buying an ETF of the S&P 500 right now means you're buying only 30% of these stocks, but 70% of the stocks which we believe have deteriorating risk-reward characteristics and will underperform in the current economic environment. We see that in this economic environment, only the economy is troughing, as seen by the PMIs, and looking to improve. Other business cycle indicators, like corporate spreads, stock markets, and PEs, are significantly higher. This is why we believe that as global economies improve, the earnings of the stocks that are tied to this improvement, like the cyclicals, will outperform.